obviously there's tremendous stress on all global energy resources, and uranium's been a great winner out of that. But so have oil and gas prices. So really just looking at what's been happening and in the space. And I know that there has been sort of sustained questions from the network over the last 6 months in particular about, is this a sunset industry, sunset kind of multiple crushing valuations. Every time oil price goes up, stocks hardly move. And when oil price goes down a bit, they go down a lot. And that was definitely true for a period when you look between sort of March and February and August. But what we've seen in the last few months, which has been the main argument that we've had, is that it's really just more pessimism from the market. We had two crushing once in a decade oil price crashes within 5 years of each other, 2016 and 15, 16, and then again in 2020 because of COVID, that really undermined confidence in Australian energy stocks. You've also got these energy stocks just making up a tiny percentage of our ASX index, or various indices, which then makes it very easy for institutions who are indexed, their performances compared to index performance, to ignore the space. So what we really needed to see, and what has been our main bullish argument for the last 12 months, is that eventually we would see price action in oil and gas prices that would puncture that pessimism and really make the sector too hard to ignore. And we're really seeing those levels now. So, oil price above $80, heaven forbid it goes to 100, which is not a stretch at all, given how quickly demand's flooding back. But even LNG, or especially LNG, with spot LNG now above $32 per MMBTU, I mean, these are extraordinary earnings conditions. And it really quickly, I know from talking to some institutions, they're switching from other spaces too hard to what's the key leverage play in the space. So that's definitely been borne out in more recent share price performances. I mean, stocks like Woodside, they've doubled in the last 2 months. They've doubled the oil price performance in their share price recovery. Santos and Oil Search, Karoon, Cenex, they've all performed strongly, across the space. So what we're really looking for now is how that demand is met by recovering supply. So really OPEC Plus group will be the key supply addition. Now, obviously, they've got still considerable amount of supply curtailed. It's only logical that comes back online. But really what we're in now is a position that if they don't bring that supply back on in an orderly fashion, you could get that kind of price shock action where it pushes oil up through 100. But what especially gives us confidence is not necessarily the prospect of oil going to 100 and waiting for that Goldman Sachs note that will come out any day now saying oil will go to 200. But it's not really about the upside. It's more just about the market's recovering confidence in where a typical cycle is for oil. So it's not $40 to $50, or $40 to $60 is a typical range. It really is 55 to 75. And if you apply that kind of step change in market implied valuations, the whole sector is just going to re-rate strongly. So, our key picks, while they've done well, a lot of stocks in the sector have done well. I do think that there's still a considerable amount of money on the sideline that, as I say, is going to be dragged back into the space because of that building underperformance if you're not there. So, for all of the last 11 months, we've been pushing for everyone to hold two energy stocks, not just one. But I think that's still true at this stage. Don't take profit too early in the cycle that is just looking extremely encouraging. So, Woodside and Santos are our equal top picks. But when you go the next rung down, it has been Karoon and Cenex. You have to say that after all of the activity this week with Cenex's approach from POSCO, pushing it up near our valuation, that we've pulled that back to a hold. So now really Karoon is the key pick in that mid to small cap space, followed by Beach, which Max is a big fan of as well and has some good valuation legs to it. So that's probably it on the energy stocks, Tom. I'll quickly just go through BHP as well, where we've done pulled the trigger on the upgrade to buy. So obviously been sweating our rating the whole way. The stock's been sliding down, but by no means think that we can pick the bottom. But really quite nervous about where the iron ore price is. A lot of intelligent people saying that a lot's already been factored in, and it's quite true. Like when you back solve what the current share price is implying for BHP, if we keep all of our assumptions unchanged at 60, unchanged across all of the commodities, and then back solve just what the iron ore price is to get to the current share price, it's really showing that $61 a tonne is now factored in for iron ore. Now, if we move all of the commodities that BHP is exposed to their spot price and then back solve the iron ore price to see what the current share price is factoring in, it's only $20 a tonne. And what that really means is that all of BHP's commodities outside of iron ore are going from strength to strength. You've got, as I said, LNG prices above $30. You've got oil above $80. You've got nickel above $9, copper above $4.50. I mean, it's just an incredible earnings environment when you go to the rest of the business. So iron ore still around 130. Still quite nervous that maybe we haven't seen the bottom. And I know that there is a lot factored into these stocks for that weakness that we've seen. But I do think that earnings direction will still drive short-term performance. So by no means do I think we've seen the bottom necessarily, but I just think that we're at an attractive level where you've got 20% upside to our valuation, which we've recently downgraded iron ore for, and then a 10% dividend yield, which is at this share price pretty conservative. It assumes that a lower dividend than what they paid last year, and essentially well supported by those strong earnings. So in this extraordinary coal price environment as well, is BHP enticed to or incentivized to consider offloading the rest of its coal assets, high purity met coal assets in Queensland? It's a distinct possibility, and that would mean even further capital management would be on the cards, given they just don't need that capital. They've got so much free cash flow coming in. So we do confidently move to a buy on BHP. Just think that don't go too hard all at once. I'm always a big fan when you've got sliding commodities of just phasing in gently or gradually. But definitely happy to buy it with a just above $46 price target.